Good morning, everyone. I am Natalia Lemus, part of the Marketing and Communication team of the British Columbian Chamber of Commerce, BritCham Colombia. In collaborate with our affiliate J del Rio, we are welcome to your event, Transfer Pricing Hot Topics for Latam and Europe. Today, we are going by three learning experts. It is my pleasure to introduce Mike van Vuuren, the co-founder of Coperitas with a decade of experience in the tax sector. He has dedicated his heart and soul to helping people make their transfer pricing work and has consistently used the Coperitas software solution provide clients with practical and useful software solutions in their day-to-day practice. Today, we also welcome Richard Slimmen, co-founder and CEO of Quantera Global. Thanks to his 3 decades of experiences, he's a sensible professional with extensive experience in international corporate taxation and high-level tax function and acts as a competent authority in closed transfer pricing cases, as well as learning the APA team for tax authority. He combines his expected knowledge, network, and contacts, and a critical analytic skills to provide especially transfer pricing services on an international scale. Furthermore, we would like to introduce María José González. After going J del Rio in 2009, he started the transfer pricing area in the firm. Now, with 13 years of experience, she specializes in complaints with companies on transfer pricing matters through balance company and their projects, as well as through determining intercompany policies. With her multiple of experiences, coordination, and management regional projects in Latam, she demonstrates her expertise in all matters, learning to study consultation and project audits before tax companies. We take this opportunity to thank our Diamond members, Shell, Compensar, Pilgrim Security, Araujo Ibarra, Morenos, and Pasar Express, as well as Auditor, BDO, and PR partner, Charla. Now, the floor is theirs.
Thank you, everyone. We really appreciate that you are here in the webinar on time. And basically, the idea of today is to have a conversation regarding these hot topics in Europe and Latam in transfer pricing topics. So we are going to concentrate the agenda in 4 or 5 topics that is related to transfer pricing main concepts, in case there's someone here that does not have any idea of what is transfer pricing, and what are the obligations in Latam in general terms and in Europe, all related to BEPS, and this is the most new, I believe, the BEPS 2.0 and the implementations and how this can affect, going to the controversial transactions that we have seen between Latam and Europe, and last but not least, how we can make your life easier with your TP documentation. So, well, for those who are lost in this conversation and do not have any idea what is transfer pricing, I'm going to give a big view of this. As you know, transfer pricing is a price, as the name say it, and it's related to intercompany or multinational prices between in the transaction that they transact with between them. So, if you are in the market, we know that if I'm going to purchase or provide services or receive services, probably the price established is according to the demand and the offer. So we have market issues that are actually established at different or opposite compositions in the market that establish the price. In transfer pricing, it is the same multinational group, and so the incentives are the things related to the intercompany transactions usually can be seen as something that can the related parties will seek to maximize the profitability of the multinational company, not their own profitability. So at the end, this can bring some typical tax incentives related to it. And for example, that if I can pay 0 pesos because it is relevant or convenient for the entity or the multinational group to leave the money in X country instead of X country, so the tax base or you can pay taxes or less taxes in a country or another. We have tax incentives. Probably a transaction can be seen differently in one country and another. So at the end, the idea or the general idea is that typically in transfer pricing, you have incentives to not act as the market. So what the jurisdictions did in one moment in life, and the OECD and tax convention and model convention, etc. So they say that all transactions with related parties should be taken care of. They were done with third parties in similar circumstances. So the idea, and that is what we call the standard arm's length principle. And the idea in transfer pricing is that we have to act in this sense, and the authorities or jurisdictions, we are going to see it in Latam and Europe. We all agree basically now in the world that the arm's length standard is the one that we are going to follow for transfer pricing purposes. So we try to avoid double taxation. What is transfer pricing important? And the end, I think, and Richard, correct me if you think differently, but at the end, I believe that one of the most important things that pursue transfer pricing is that as it affects your tax base, you have to have, or authorities pretend that you as taxpayer have a fair tax base. And in case if they do establish that you didn't have your transfer pricing correct, and there is an omission, they will adjust that price, but at the end, the risk is that you will have double taxation. And at the end, the idea is to avoid double taxation between countries. And this will create these kind of issues.
Yeah, maybe to add to that, Maria, why is it important? Simply because transfer pricing more or less determines how much each country can levy taxes. So the proper application and implementation of transfer pricing determines how much taxes countries can levy for profit taxation. So there's a huge incentive for countries to scrutinize and to be very alert whether the transfer pricing is applied properly, because it so to say, it divides the pie of the overall tax amounts across the globe.
Yeah, and at the end, the way that authorities request taxpayers do support that they are correct in their transfer pricing is at having transfer pricing documentation. And with the transfer pricing documentation, we have the reports, we have the informative returns, all the things that probably as taxpayers or companies you are used to deal with, and that each time becomes more and more aggressive, this kind of documentation. We have the local file, the master file, but the country by country, but and the idea of this documentation, although I'm saying it like that, is to actually be able to support your transaction, and that in case that authorities ask you, you actually have the capacity to establish that you could act correct in terms of transfer pricing, so you can avoid these kind of adjustments and to have this kind of these issues between jurisdictions that may create you a problem.
Yeah, I think sometimes I have questions, Maria, about why should we bother about transfer pricing documentation, and because you only do that to accommodate the authorities. It's a mandatory obligation, so to say. Initially, transfer pricing documentation was established to provide some sort of a level playing field for the authorities, because they had a backlog in information about companies. So it is about informing the authorities about the dealings of a company, but it's also an opportunity to establish a proper understanding by the authorities of the operations of your company, because if you're facing a tax inspector that has a false idea or a wrong notion about what your company is doing, that may lead to difficult questions, wrong assumptions about how much profit should be allocated or not to a certain activity. So the documentation is a means to manage some sort of exposure by misunderstanding on the authority side. So it's a risk management tool in my perspective. It's not just preparing a paperwork for the authorities, but it has a goal. It has a goal to avoid, if possible, discussions about whether your profit allocation is properly implemented. But even if there's a dispute, it certainly will help you to substantiate your position rather than just having to talk or convince an authority without that documentation that to back you up. So it's a risk management instrument, so to say.
Yeah, and you cannot even start the conversation if you don't have this document. I mean, it is basic. So what is the big picture in Latin America? Because Richard and I were discussing, like, how do we see Europe? How do we see Latin America? And basically, sometimes we think Europe is one thing and Latin America is one thing, but we have to understand that we are discussing about many countries with many different politicians and politics and tax policies, and that probably we are not as together as one as a region. There is Mercosur, so in the south there is certain established alliances between countries, but at the end, we all part from different sides. But as you can see in this, and I don't pretend to read each country and everything, but the idea of presenting this information from the SIAT, that it is the international organization for tax authorities to have all this. So what the idea is that you can see that all countries, basically all, because there are 3 that not, have some transfer pricing rules in place. And documentation, yes, but rules. I mean, I want to say that you have to review your transfer pricing in order to be able to deduct or to have a X or Y tax impact. So we almost all, now I believe all, an exception is in El Salvador, but minimal is follow the OECD guidelines. So I think we are aligned, and this will be interesting with all that BEPS to zero. What is going to happen if this falls into the in the OECD guidelines for transfer pricing, since in all or most of the countries they are just a source of interpretation, and there are also certain specific rules in each country. For example, in Colombia, we have this for commodities, we have specific rules or specific definitions. Also in Argentina, and we have a specific definition on intragroup services. But in general terms, and what I want to say is, everyone here now in Latin America is now in the ship, and there were tens. I don't know. There are countries that probably starting 2 years ago, 3 years ago. So transfer pricing practice in Latin America is not that old. Probably for Colombia we are more used to. In Mexico we are used to. In Argentina we are used to. But there are countries that they have 5 years in transfer pricing, so it's really incipient market. So we can see, or we can expect, all countries, not Brazil, because Brazil is the hot topic. Also in Latin America, we all know Brazil used to be this black sheep that only has safe harbors, and they didn't follow the arm's length standards. So transfer pricing in Brazil was differently, but from this year they are now following the arm's length standard. So basically, all countries in Latin America, we are aligned in this. We follow almost the same transfer pricing methodologies. Not almost. We follow the same. In some jurisdictions, we have 5 methods, and some jurisdictions 6. But in general terms, we follow the same methodology. I believe that Latin America, in the big picture, right now is in some countries, a lot of sanctions of non-compliance. All countries have sanctions, but what I mean is, for example, in Colombia, we are starting to see transfer pricing audits more serious, in a more serious or more deeper discussions. But in the past, and always we have seen that it is more a sanction transfer pricing policy of, if you do not comply, I will apply the penalty, and it is onerous. This is changing the substance, and I believe that it is going with work. We are seeing I think we are half and half. For example, Mexico, Argentina, Colombia, Chile, which other country here? Nicaragua, I believe, Peru, Uruguay. We have local file, master file, and country by country report that it is section 13 in BEPS. All rest of countries probably just have the obligation of transfer pricing documentation, but it is expected that all countries will be there to be mandatory to have the master file at least. We can see also increase in transfer pricing cases. I put it here, direct and indirect, because not necessarily all are transfer pricing audits, but there are audits or tax audits that have big transfer pricing issues, like cost sharing agreements, like well, in Colombia, for example, these benchmarks, it's etc. But if I go to Mexico, the discussions probably are related right now in terms of deductions or restructuring. So I was investigating, and I found in the recent years, this is recent, I mean in the last 4 years, we have cases in Argentina, Brazil, Chile, Colombia, Costa Rica, El Salvador, Mexico, Peru, and Uruguay related to transfer pricing. That is a big issue because we are not used to see cases in courts. I mean, there are a lot of audits, but not necessarily going public on court, and we are now going to that level of discussion with authorities. And of course, the main obligation, I believe, for all countries here is you have to file or submit your transfer pricing returns, not necessarily the report. In Colombia, you have to present it. In Mexico, you have to present it differently, but at the end, we have all rules related to informative returns, and that is what is the authorities in Latin America are actually, it is the way that they control transfer pricing in terms of what it is compliance. I think we are far away. We're not far away, but our tax authorities in Latin America, not all tax authorities really have the capabilities for transfer pricing, because it is a really specific topic. So we are moving slowly, but going there slowly. And just as example, I'm not going to go to this. It is just an example to see how equal and how different can be requirements for each country. For example, if I go to Colombia, I will see thresholds. They are not that big. One that will I have to submit my informative return, and if I pass certain threshold, I have to submit my transfer pricing report. If I go to Mexico, I am mandatory to have the transfer pricing report. I'll give it to authorities on their request until certain threshold, and the informative return. And for big taxpayers, then I have another obligation that it is a local file, master file, and country by country report. So we just segment the compliance in different kind of taxpayers. In Colombia, it's for everyone. In Mexico, it's different. And in Costa Rica, it is only mandatory for you to have, for example, your transfer pricing report in case for your accounting basis, and in case authorities ask, it is mandatory to have your transactions with the arm's length standard, but there is nothing to present. So we are in words that there are really strict countries versus countries that they are incipient in transfer pricing issues.
Yeah, I think Maria, it's relevant for companies to be aware of the fact that the thresholds, the local specific regulations may vary between countries, and you will have to look at the individual local regulations to be compliant. Whereas from a, let's say, a transfer pricing perspective, content-wise, so whether you apply the principle is something that covers all countries, but there are a lot of compliance-related obligations that can differ quite substantially between countries. And as a company, you will have to navigate all those individual countries.
Yeah, a complex issue.
Well, I wanted to illustrate a bit like how is Europe looking at transfer pricing compared to Latam. Obviously, you can imagine that the authorities look at the issue the same way, whereas in Europe, the authorities have been much longer applying transfer pricing concepts, and they have much more experience. But still, it is the same. They have evolved in a bit, let's say, further stage. They have a lot more capacity to deal with the issues. But also in Europe, you have your documentation requirements. As I said before, the documentation is intended to inform the authorities about what is happening within your organization. And some time ago, it was decided as part of the OECD, let's say, efforts on a global scale to see whether they could apply a bit of a standardized format on how and what to document in order to establish a good understanding of the operations of a company. And that has led to a master file that actually looks at the group as a whole and identifies the general approach of a company, of the operations, and gives you as a reader a bit of an understanding whether you look at a producing company, a pharmaceutical company, or a household appliances company, and how that supply chain is designed. That is applying to the whole group. And then if you have a local file, that is triggering all the individual country relevant transactions that will enter the numbers into the equation. So if you combine local file and master file, the thought behind it is that the authorities will be able to evaluate based on that on those files whether you as a company have implemented the arm's length principle properly within your organization. Now the master file and local files are more or less universal within Europe as the standards to be applied. In addition to those two files, countries have also additional filing requirements. Sometimes there are additional returns, sometimes you need to provide additional information, but there are also thresholds because there is a good understanding that it's quite a compliance burden for companies. And if you're a small, relatively small company, but you're still active in more countries, you will have to apply the arm's length principle, but at the same time, it's quite a burden to actually go through the motions of making a master file and a local file. So countries sometimes have thresholds. For instance, in the Netherlands, if the group that you're part of as a company is below the 50 million euros threshold, you don't have to provide a master file or local file. And I want to stress that it's just that you don't have to apply the formats of a local file and master file, but it does not take away the fact that you are obligated to enable yourself to substantiate that you have applied the arm's length principle properly. You only have a bit more freedom how to substantiate it, so you're not forced into a specific set of documents, but you're not free of the obligation to substantiate your transfer pricing. There are countries that apply documentation rules that include you to file the actual documents on an annual basis, but a lot of countries require you to make the files and have them available upon request of the tax authority. So if there's an audit taking place, one of the first things they will ask for is, please provide me with your transfer pricing documentation, because that's a very efficient entry into understanding the business that you're looking at. So they will request for that transfer pricing documentation, and you are then expected to deliver within a short time frame. The time frames differ per country. There are time frames of 7 days, but there are also time frames of 30 days, or sometimes even longer than that. So there's a bit of a differences on how local countries apply that. But the major differences is whether you should file it proactively or whether you should have it and only provide it upon request. And there's a bit of a difference between countries how to approach that. I think within Europe, English is a common language, but still countries can require you to provide documentation in local language. In practice, I must say many countries apply and accept documents in English, but sometimes if the auditor in question or the tax inspector is not sufficiently fluent in English, they will and they are allowed to require documents in their local language. That is something to consider, because as it is something you have to explain in a lot of countries, it's very efficient if you can apply a common language. Otherwise, you have to translate, and some things can get lost in translation. If you have to apply 5 or 6 languages for the same document, there is an inherent risk on that. So that will happen. Non-compliance impact, I think that's something to consider from a general perspective. If you do not comply with your transfer pricing documentation specifically, what does it mean? What does it result in? And then a very important part of it is that you should understand that in general, as a taxpayer, as a company, if you do not meet your documentation requirements, you will have a bit of a difficulty in substantiating that you applied the arm's length principle. But if the tax inspector assumes or thinks or reasons that he's not in accordance with your tax returns, he may make an adjustment and then ask you to convince him that it's wrong, that his adjustment is wrong. So it's a bit of the other way around. Initially, a tax inspector should prove that the tax return was wrong, but if he did not comply with your documentation requirements, that situation may be reversed, and that you will have to prove as a company that the assumed adjustment of the tax inspector is too high. And in litigation, it's very important to understand that the burden of proof in court in transfer pricing cases often is a very determinative benefit. It's much more difficult to prove something is wrong than to prove that it's right. Another part is if you don't comply, companies may be facing penalties. Also, European countries will apply penalties. We have a client that is now faced with a penalty of not filing its documentation in time. So it had filed, but it was too late, and still there's a penalty of more than 30,000 euros applied, which is quite a sum of money. And countries have different penalty regimes. Sometimes it's low, sometimes it's high, but it's something to consider because management of multinationals is not very happy to be confronted with penalties. Even if it's relatively low, penalties are a bit of a thing that they want to avoid. So that is something that may be attached of being non-compliant. I think the compliance also is relevant for the exchange of information within Europe. Exchange of information is maybe much more developed than in Latin. There's an automatic exchange of, for instance, APA, so agreements with tax authorities are exchanged with automatically in some sort of a database approach. Countries can apply that, look for the information, ask for more details. There's a lot of exchange within the EU companies, but also a lot of European countries do effectively exchange information on the treaties with treaty party countries. So that makes it relevant to understand that when you apply your documentation, it's not just one side of the transaction that is looking at that documentation. You will always have to take into account that the other side of the transaction, the other country involved, will also have a look at it because that information is flowing between the countries. And that is something to be aware of, I think. Maybe Maria, do you have some experience with the information exchange within LATAM between the countries?
Yeah, I was going to say that it depends because, for example, in Mexico, we have basically a treaty with every country. I'm exaggerating, but we have a really easy way to operate because we have a lot of treaties and information exchange channels, but not necessarily for all Latin American countries. So I believe the channels are being created because all tax authorities are interested to be on the same page in this sense. But not all countries have access to the discussion. Well, now, because now we have signed all countries MLI and a lot of Latin American, so basically all Latin American countries signed the MLI. So with the MLI, that will allow or creates this mechanism that will allow the exchange of information or more clear information to all counterparties in transactions.
I think in general, countries are seeking ways to exchange the information, but they will have to deal with the formalities and the legal issues to be addressed. But they are working on it. I think maybe in a different.
Happening. I know in Mexico they actually have these reviews, constant reviews of the country-by-country reports provided by other jurisdictions, and they have, I don't know, quarterly or they periodically they have access to the country-by-country reports, and they have discussions on it. So it is happening, but I believe not all countries have access to it.
No, it will be different per country on what they do with the data, but I think it's very relevant to understand that data is being shared, it will certainly, especially when you think about AI developments and computing capacity that exists nowadays, that a lot of data can be analyzed much more than it could be 10 years ago. And companies will be confronted with the results of that analysis. Maybe very briefly on the general European landscape, because it's relevant to understand that in Europe we have multiple stakeholders that provide some sort of regulation. You have your local country, obviously, that has its own laws and regulations. Then you have the OECD, that is a global, let's say, stakeholder that provide guidelines, which are not mandatory, which are not binding on countries, but are having a very massive impact on the interpretation, for instance, on the arm's length principle. But in Europe, we also have the EU as an institution that is providing regulations, and those regulations are mandatory for the EU countries sometimes. Sometimes they're optional, but it's a third-party stakeholder that actually can interact with the country regulations, and that provides for a bit of an additional perspective on things that countries in Europe need to work with, and companies that are active in Europe will therefore also be taking into account the impact of the EU developments. And I'm not intending to go into very brief detail on them. I just wanted to mention them because they're relevant. They're tax-related initiatives from the EU. For instance, the Business in Europe Framework for Income Taxation, rather known as BFIT, actually is a proposed initiative by the EU Commission, which is not active yet, but it's a development. And they're seeking to harmonize the EU taxation, including transfer pricing regulations and allocations of income. And part of that is also a specific EU TP directive, which tries to harmonize, even within the EU, the interpretation of certain transfer pricing issues that may not be as harmonized as they want to. So there's a specific aim for the EU to further harmonize things. There's also an initiative to what they call debt equity bias reduction allowance, that is to take away the differences between equity and debt in terms of deduction of a notional interest in respect of equity, and a limitation on interest deduction to balance them a bit more. That is now being under, let's say, decision-making within the EU. The third one, maybe you've heard all of the ATAD, anti-tax avoidance directives. There's also a shell directive that actually tries to combat the abusive use of shell companies, companies with very little or no substance, and let's say abused for tax reasons. It's currently underway. And then maybe also relevant to understand, the EU is not just focusing on the big companies, but it's also looking at small and medium-sized businesses and trying to limit the compliance burden. There's a relief package being suggested by the EU that, for instance, also includes a bit of a simplified approach to taxation of small and medium-sized enterprises active within Europe, from one headquarter company and applying several permanent establishments in other member states, and to allow that to be treated, simplified, more, let's say, streamlined without too much of compliance burden issues. That is specifically for the EU, but it shows you to understand that the impact of the EU in that tripartite cooperation, OECD, EU, and countries, is something that companies can really be impacted by.
And at the end, I believe that you are the ones that have the primary reactions to OECD, and all these kind of things eventually will end up in some kind of regulations everywhere, because you are the test part. They are testing with you somehow. With you, I mean Europe, you have the capacity to react to these kinds of things. Yeah. And with here in Latin America, we expect to have this kind of relief for small and medium, because I believe that there is a lot of, here there is a lot, for example, a lot of countries, you have to challenge or to discuss the local transactions, domestic transactions, so there is a lot of issues there. So going general to the next point, we are going to talk about BEPS 2.0. I'm going to go really fast in this slide because I want to believe that the audience, have heard about BEPS. If you don't, BEPS, it was created in 2013. It was an initiative of the OECD to try to set some guidelines related to base erosion and profit shifting. They identified that countries have different jurisdictions have this issue of the allocations of profits and how taxpayers were trying to avoid or having erosion of the base. There were 15 actions related to that. Basically, they in three main topics, that it was creating transparency, creating more substance, and currency between things. So related to transparency, we are going to see that they have the multilateral, the MLI. We have several actions for transfer pricing is 8 to 13. But at the end, always the idea has been to set a more clear field of game for everyone. So everyone we have, or we can avoid double taxation for tax purposes. Well, BEPS had different. I'm going to talk about BEPS 2.0. 2.0. It was a name established. It is not something different. But at the beginning, it was intended to attack this thing that was happening with digital economy in all countries. That basically was that probably I have my company in the Ireland, but I don't know, my consumers, Netflix or whatever, they are in Colombia, no, or in Mexico, in Argentina. So the only entity that was paying taxes for that, it was the source of the jurisdiction. So it was at the I'm saying at the beginning because this changed into some hybrid thing weirdly, but the idea is to focus on market instead of focusing on or where the taxpayer is. That is how historically has been taken care of. So in this sense, the idea is, or they created the OECD plan, Pillar 1 and Pillar 2, we call it like that, but that pretend to allocate the profits in the market jurisdiction, morally, and to create Pillar 2 and to create a minimal tax, because I talk about more related to Pillar 1, but Pillar 2 is more created a minimal tax, so to avoid shifting your profits to jurisdictions that has benefits related to it, and to assure that someone, I can say it like that, but to assure that someone is actually paying for the money, and hopefully in the correct jurisdiction, and trying to be in the correct jurisdiction.
Yeah, I think when we discuss about Pillar 2 and 1, especially Pillar 2, we will see that there's a lot of mechanisms in place to make sure that somewhere, somehow, tax is being paid. But I think internationally, a lot of developing countries are facing some challenges there, because it has an impact on their tax-related incentives that they think are relevant for the investment climate. So not every country is as happy with the Pillar 2 approach in that respect, yeah. But there's something to think about.
Zona Franca in Costa Rica is the same. We have certain areas that basically is to attract investments and to try to help companies more than to avoid taxes just because.
Yeah. Briefly, this is just a visualization of the Pillar 1 and Pillar 2 that are currently very much under in the attention of countries, but also large companies. Pillar 1 is for the largest companies. Maybe we should not spend too much time on that respect. But part of Pillar 1 is. I'm sorry, Maria?
No, go ahead.
Okay. Part of Pillar 1 is addressing some sort of a simplified approach to determine, let's say, the appropriate allocation of profit to baseline distribution companies. So that's the amount B. That is the most relevant part. So the pillar 1 is about market countries, but also about a simplified approach. If we look at that simplified approach, it's about a very specific part of activities, baseline distribution activities, let alone the definition. But if you qualify for that type of operation, the approach is that you can look at the table, determine where you are, in which industry group, what intensity level you have, and then you are able to determine the margin that you should apply for that type of operation. The major benefit of that is that you should not and do not need to worry anymore about substantiating your profit margin, because it's like a safe harbor approach. If you apply that margin, you will be not challenged by the authorities, because they all embrace that table. The difference between having a benchmarking type of discussion obviously is that you will have to qualify for that baseline distribution type of activity, and at this moment in time, that qualification is not as black and white as you may think. So there's still discussion possible about that approach, but it is a step forward to a bit more formulary, a simplified approach in making sure that countries will apply a margin, a profitability to certain type of operations that will take away the disputes that may arise in those type of operations.
But I really have said, the issue here in Latin America is, since OECD guidelines are just for interpretation, we are really not sure what is going to happen about amount B, because it's going to be implemented, but it's going to be accepted in the moment that, do I still have to do a transfer pricing report? Because the idea is that you don't have to do it, you just have to follow the formula. But is it going to be accepted? And really, not jurisdiction here has pronunciated about, okay, amount B in place, you have to check your boxes and let's go. Because we are the amount B kind of entities. I mean, we are in Latin America a lot, the distribution in the wholesalers and the marketing companies for this. So
yeah, I think, Maria, it's a fair question. Do you still need to provide documentation if you can simply apply the table? But I think it's not as simple as that, because applying the table more or less replaces the need for a benchmark. And if you think about transfer pricing, a benchmark is only the last stage of documenting your transactions. The first stage is that you need to explain and identify what you are doing. Only then you can actually determine whether you are within the definition of baseline distribution, and if so, you can apply the table to set your margins, so you don't need to benchmark anymore. But transfer pricing is much more than just benchmarking. So the need for documentation that identifies your operations and the transactions relevant will still be necessary. Looking at the time, we may want to go to the global minimum taxation, the pillar 2. We don't go into the details, but I think the general idea is that there's a minimum taxation levied. The taxation is levied whether or not a local country applies taxation on that income. And the mechanism is that if you do not tax it yourself as a local country, other countries may levy tax instead on that income that you are not taxing. So the impact of the pillar 2 regulation will show, and maybe that will also impact many Latin countries, to determine whether they are having a sufficient rate of taxation. But if they don't, they still may want to consider whether they will include a special tax, a top-up tax, to make good for the 15%. So there is no taxation of their, let's say, taxable base in other countries. That is a country by country decision to be made. But anyone can imagine that if there needs to be taxation, most countries want to tax it on their own. But the difficulties with a lot of developing countries is that they need to readjust their mechanisms for tax incentives or tax-related incentives in order to still be attractive for foreign investors. That is something that is being triggered by the Pillar 2 approach, so to say.
And actually, Colombia has already put in place something about it, not necessarily attached to the Pillar 2, but attached with the global minimum. So, I mean, with its own approach. Well, I'm going to go just to mention what are the more controversial transactions between related parties, Europe and Latam. We have to mention the services, the interest, the royalty, and the things. I think for time issues, we will discuss probably the interest ones that actually they are like hot topic in Europe and that may affect.
Yeah, I think just to be very brief about this, financial transactions in Europe have been quite under attention last few years. There's a lot of focus on financial transactions. Use of cash pools, guarantees, loan benchmarking. It's all being done much more intense than a couple of years ago. I can imagine that will also apply to Latin American countries because they are funded obviously by foreign loans. So that is something that is triggering a lot of attention and therefore also a lot of dispute about if you don't document it properly, you will have to deal with a lot of questions. So especially financial transactions, I would imagine, are something to consider as an attention point because it has been it has triggered less attention in the past, and there's a bit of a backlog to work on, I think, from a company perspective in terms of substantiation and documentation. But maybe from a time perspective, we go to the automation part. That is
and everything that we have said basically is to help you all to understand that transfer pricing is having more importance, having changes. We don't know what kind of changes, but we know that, for example, in Latin America, we have a lot to present. Taxpayers have a lot to comply. They are a lot to compliance that not necessarily is a substance, but you have to comply and you have a lot. So Mike here, that has been present here,
yep.
He has a solution.
Third
He has
time.
all our problems as taxpayers, as
Yes.
company, to help you vote with this hell of documentation.
I think a nice bridge, Maria and Richard. Also for the audience, there's a lot of information, a lot of things that Maria and Richard teach you in the last 45 minutes. But why is automation that important? Because we're in a stepping stone of more and more regulations, and I'm more like the guy with the pictures, a bit of humor as well. But what we see in practice is there's already a lot to do, but every year we have more and more to do, whether it's compliance, whether it's non-tax related, whether it's more thinking about your strategy and your design. There becomes more stones to the point you cannot carry it anymore. So you need some support there. And I always tell my clients, the automation could be your support in relieving the burden on your back, not having too much stones and work on things we can automate, but then keeping your focus on things that truly matter. Because a lot of things, complex things like pillar 1, pillar 2, you don't want to hassle with TP documentation, as you need to focus on those things. We always work with the end game of transfer pricing. And this is the most ideal circle we can see within transfer pricing. It summarizes all the things Richard and Maria told us about the last 45 minutes. And it starts with your company itself. So it starts with the business and the data within the business, because based on the data, you can design your transfer pricing policies, you can set your strategy, because there's lots to take into account, whether it's your risk appetite or actually just your resources within your company. You need to find a way how to deal with transfer pricing. And if that policy is set, so the first step of transfer pricing, then you need to operationalize it. And there is where the first automation comes in. You need to work with ERP systems, you need to do calculations there, you need to have some insight whether the TP policy is applied well, or you need to make any adjustments. And in that part, you can already see the power of automation, that it relieves you on the old-fashioned work in Excel and Microsoft-based apps, where you can get some help here and there. If we then go into compliance, because it's a topic we covered a lot today, there's a lot going on in Latam, there's a lot going on in Europe, and we see that it's a cornerstone of transfer pricing, telling your story to the tax authorities. I always start with the 3 levels of compliance, where you first need to do the risk analysis, which determines what you're going to do in which country and to what extent. Then we go to the when, because not all countries are at the same level yet. You don't need to file all the documents at the same time, so you need to take into account those deadlines, and you need to make a planning around it. So you need to allocate your resources on the right timings during the year to meet the overall end game of TP. And at the end, there is also a how I'm going to fulfill my compliance obligation. I'm going to do it the traditional way with the Microsoft Office suite, which we see a lot today, struggling in Excel, breaking formulas, copying the information into Word documents, making manual errors there. Or do I embed that process end-to-end into automation solutions and do not worry about it anymore? Does it stop there? No, it's not. Because in many cases, you will face audits locally. And if you're prepared well, you will go through those audits very well. There are no penalties there if you're prepared well, but there's always a hard time changing your story. I remember Richard telling something like, you cannot unchange your story. It's harder to unchange your story, so you need to do it the first time right. I think it's true. You need to do it right first time. And the end game of TP, the last step, is the business monitoring, which is always ongoing. Your business is changing directions and you need to follow in tax. And as well for transfer pricing, you need to adapt to those changes and then start the circle over and over again. If the business changes, you need to rethink your policy, rethink your documentation, and prepare again for the next audit. And this is what we call the end game of TP. I will also highlight some common challenges with automation. I always get the question like, Mike, what are people struggling with? And what do I need to think of with automation? So I think there are 4 categories, like system challenges, people challenges, process challenges, and data challenges. Some get mixed up, but there's always a profile at companies which they think why automation is not going to help them. But I think there are opportunities there. And to just highlight some of these system challenges, what we a lot encounter is a combination of systems. So having your ERP system as your source of data, you can have multiple ERP systems locally, and you need to find a way to combine the data into a streamlined process that is usable for your purpose, whether it's operational transfer pricing, TP compliance, or even refining the data to prepare for an audit. There's a good challenge there, but a good software solution which let's say it combines or gathers all that data, combines that data in a way you can use it for transfer pricing is key in this landscape. Then I want to focus on the people challenges. We see a lot of people and tax teams having an argument like, we don't need automation because I have people. I have sufficient people with sufficient time. But imagining people leaving your company, you need to retrain the next person, or even worse, all the work that a previous colleague worked on got lost. There's nothing written down on paper, but all the information is in their head. So when a person leaves the company, all the knowledge and information is also leaving the company. By embedding that information of your colleagues into an automation solution, helps and prevents you to be dependent on key persons. I think the lack of knowledge is also a combination with also having transfer pricing knowledge. If you don't have that, there's not a problem. There's a lot of advisors around you who can help you out on that part. If we then focus on the process, I think that a lot is helped with a decent workflow management. So there's a lot of time-consuming projects within transfer pricing, so you can automate it. There's a lot to gain there, but it's also in terms of the workflow. So if you set up your workflow in the right way, it eases out your stress level of thinking about certain things. You can let the software and the people work together, which reach the end goal much quicker than you can think of on forehand. And the last part, and that's I think the most important one, is the data part, where there's Excel-driven work currently, where you can break calculations. You don't even see it when a calculation is broken, so you can even work with the wrong information. And you have a potential risk of lack of consistency. If you work consistently across all your countries, you always have the same story. Whenever it's told in country A or country B, there will be a point in time where information is equally shared amongst all countries. And if you then don't have the same story in country A and country B, you're having a hard time telling the tax authorities what the right story is. So with Coperitas, I also want to highlight key things that you can think of when obtaining a software solution. We always start with legal entity management, because if you remember correctly, in the end game of transfer pricing, it all starts with your business. So it's important to have one version of the truth of your company. So you need to have all your information about your companies in one place. You need to have your legal tree in one place, and you need to store all key information around tax and transfer pricing in one place. If you have that in one place and there comes an audit, and I believe also Richard and Maria appointed it, in some countries you have 1 week to deliver the information. You don't want to get caught looking for that information scattered around your organization. Have it within one environment is key in the future. If we then focus on TP compliance, you need a reporter which can flexibly grow with your company. If your story changes over time, it needs to adapt to that story. And you need to utilize automation by flowing in data, getting reports out, which are already a good basis for your compliance effort. I think it's also good to look broader than only local files and master files. If I recall correctly, in the overviews we saw in the beginning of this webinar, there's a lot more than local files and master files. We have forms, we have maybe your policies to be generated, we have the legal agreements, we have benchmark studies. There's a lot more to do. So you need to also focus on that while selecting a software solution for transfer pricing. And in the end, if you can safely say that you've managed all your compliance burden, avoiding the most of the penalties, then you can also think about more and spend more time in transfer pricing control. Because knowing that your deadlines are met, knowing that your policy is implemented well and also tested it, that it's correctly applied, that's key in this landscape. Because if you write down story A, but the truth is in story B, you're having a hard time changing it up. I can even see at a certain point in time a world where tax authorities can just plug in your information and generate the truth themselves. And you better be in line with that truth when it gets there. So if you write down your story in your compliance reports, make sure that it's the correct information. So put some controls in it. It's also a bit of a funny one, but I think there's it's a common thing I encounter 9 out of 10 times. If we get into conversations with tax teams, I always get the question, Mike, when is the right timing to start with automation? I have no time, because that burden of rocks on their back is so high that they can find any time. I think time is always right, but you need to start small and think big. You need to grow into automation and using it on more and more topics. And if we then focus on TP compliance, I usually get the representation of this picture, like, I don't need help. I have the Microsoft Office suite. We're too busy carrying it forward. But if you add some decent wheels to it, it will go much quicker. Then you have time left for other things. And that's my main message for today, guys. Automation is new. It's upon us. There's a lot of technology. Please use it and learn it. Try to invest in it.
We are going to fall behind, because that is the world now in every aspect of the life. Transfer pricing is not far from it.
No, and it's never becoming less work.
Correct.
Okay, thank you very much, María José, Richard, and Mike, for your time, experiences, and information. It is extremely valuable for us to have you here. We hope to have you here again on other occasion, and we hope that you have enjoyed this space.